Hi everyone. I'm Toby Turtle, the official mascot of STO Summit Spring 2025. We're excited to share the recorded sessions from the world's leading summit on security tokens and real-world assets. Now, let's dive into today's talk from one of our global leaders. Hey Augustine, over to you.
Please welcome Robert Schmitt, Co-Founder of Cork Protocol, with a talk titled Tokenizing Risk.
I'm here to talk about tokenized risk and how risk management will accelerate tokenization and the growth of on-chain real-world asset capital markets. So just a quick background, I was previously on the panel, so I think maybe some of you already heard my background, but I came into this as an entrepreneur. I built my first company, Vultus, that was acquired, and then I built Toucan, which tokenized carbon credits. We built sort of a novel way to tokenize those markets and new types of like structured products for carbon credits that we got about around 100 million of carbon credits in those markets and about 4 billion of trading volume. And then after that, now I've been building out Cork. We recently launched this on mainnet. We now have about 17 million or so of tokenized risk. I'll go a bit more into how that works in the coming parts. So just like some quick context, and I think this has already been covered in some of the other presentations, but we see a lot of credits generally flowing on chain in a lot of different capacities. In particular, looking at we call credit instruments not just sort of the traditional like private credits and T-bills and so forth. We also see things like stablecoins and liquid staking tokens and restaking tokens effectively being similar to credit-like instruments because they have credit-like risks embedded into them. We're seeing sort of the mainstream adoption of like stablecoins like happening right now and really massive growth in that space. And as of the regulatory barriers are starting to shift, we're seeing really massive interest from institutions to access and adopt tokenized equities and tokenized credit markets. So we think really these markets, the future of these markets is on chain. And I think more importantly, like for these markets to really mature and be ready to scale with institutions, we have to like work on some of the barriers that are currently preventing that transition to happen and preventing that like next stage of maturity. So if we're looking at like Paradigm did an excellent report like fairly recently on TradFi's like use of blockchains and their interest in this. And if we're looking at some of the sort of core cost centers for on the TradFi side, the regulatory and compliance side is one of the major pieces. We're seeing a lot of progress being made on that currently as it relates to blockchain, but the second most important piece and is the second biggest cost center is risk management. And I would say that to date is one of the areas which is probably like one of the less explored areas in terms of like on-chain finance, but it is a really crucial piece for institutional adoption. Like we want the on-chain sort of the on-chain ecosystem to be better across all these different areas. Like there's clearly a lot of benefits in terms of tokenization, in terms of efficiency and all these compliance things, transparency and so forth, and transaction costs. But risk management is one of the areas that we have to unlock to really make the full stack better in every way. And for on-chain really to be the future, we need also risk management to be much better on-chain. And so looking at this sort of state of the art of like different types of risk management products that exist today, there's already a fair bit of progress that has been made over the last few years. And so I would like to kind of go through a little bit some of those products that are available and go through a little bit of what the next phase is for the tokenized risk markets and where the space is eventually headed. So starting off looking at one area, which is tokenized risk, which is what we're building. We've built something, I would say it's, you can think of it a little bit like the on-chain version of credit default swap. And how this works is that we have we take a collateral asset. So if you think for an asset pair, think of, for example, USDC to Athena. We can take USDC as a collateral asset and mint two tokens that represent basically two sides of this tokenized risk trade. So the one side is the DBEX swap, which enables you to swap Athena 1-for-1 for the USDC. And then the other side is the cover token, which is basically the underwriter that gets whatever is left in the peg stability module at the expiry. So through this sort of novel design, we've been able to create markets to basically trade DPEG risks of various pegged asset tokens. But this can also be extended to, for example, credit-like instruments. And we're building a V2 of this that will enable a fairly meaningful amount of programmability in terms of what types of conditions you have certain payout scenarios for. And so that this is generally a new type of primitive that's sort of enabling the actual trading, pricing, and hedging of risk, which we think will be a crucial building block in this next stage. One of the interesting things with this is that these instruments are completely composable with DeFi, so you can integrate this in a lot of different interesting ways. One of the things is, for example, like vault liquidity strategies. We've seen a lot of interest in using this to hedge vaults in case they have significant outflows. You can use these swaps to manage, for example, illiquidity risks, which is a major issue for various vaults. We also have things like looping trades that you can hedge, where people are doing various types of like carry-like trades and using leverage to yield farm. And we can use this as a new primitive to help stabilize those types of trades. I think one of the interesting things is if we compare this, for example, to the off-chain counterpart, I would say credit default swaps, is that there's a few major benefits to doing this on-chain. So one is that you have basically eliminated counterparty risk, since these instruments are collateralized and you're just operating against a contract with a set of conditions. So that's, for example, been a major issue with the CDS market in the past, and also why this market had to adopt clearinghouses after like the 2008 crisis. And so we think the elimination of this counterparty risk will be a major benefit to using these types of instruments, and also a reason why this type of like risk trading will flow on chain. Another piece of it is simply the efficiency of it. So setting up a new market, it's just a matter of like a few dollars of gas. And if you're doing this on an L2, it's it's like cents of gas. If you compare this, if you're setting up a traditional CDS, it's highly gated. There's only very large institutions that even have access to this asset class. But even if you do, you have a massive stack of paperwork to issue CDS for between two parties, and oftentimes this is in the hundreds of thousands of dollars of just legal fees to get the instrument set up, notwithstanding all the cost of actually running the instrument itself. So this is severely limiting in terms of who can access this and where this can be used. We think this massive lowering of this barrier will significantly drive also the adoption of these instruments and the way that these can be then embedded throughout other financial products. So we think the outcome of this is that we will enable new types of entrants to access DeFi yields in a risk managed way. I think you will start having you're going to have more and more different types of exposures emerge, and packaging of these different exposures where you can access fairly high yield opportunities, but do so in a risk managed way. I think that will help significantly with more conservative actors who want access to these types of markets that we're opening up, but might not be willing to take on the full risk that many sort of on-chain funds are doing. So we think this is going to be a major primitive, and we're hoping this becomes an accelerant to much of the adoption of other credit markets on chain. Another piece which is critically important is risk intelligence, in particular like risk curation and different types of ratings. So we're seeing the emergence of a lot of specialized actors within that space as well. So these specialized actors are looking at the instruments and the issuances and providing context for various actors to have as input for the risk reward assessments. One of these is credit ratings. So the top right picture is a picture of Credoro, which was one of the earlier ones that like pioneered this. So they got investments also from S&P and have been building out basically risk sort of similar to what you would have in S&P and Moody's and so forth. You basically have a risk scoring of various instruments. And they can also risk score, for example, vaults. So they have a risk scoring for various morpho vaults. And I think an interesting, if you're looking at the statistics, for example, from Credora, you're seeing the vaults that have risk scores are significantly outperforming the ones that don't have any risk scores in terms of their ability to attract capital. And so I think this type of intelligence is critically important for people to have as input to their risk models. And I think seeing the sort of emergence and growth of that space is going to be really quite important. Another type of model is the sort of risk curator model. So this is like slightly, I would say, slightly different model than simply credit ratings, in that oftentimes you hire a risk curator to perform risk assessments of various exposures. Oftentimes it's lending protocols, CDPs, things like this that are hire, like they're renting services from like actors like Llama Risk or Stakehouse or so forth. And we're also seeing the growth of this sort of risk curator model embedded into lending markets. So for example, Morpro has these curated vaults that have multiple billions in them that has become highly successful. And we think that's likely a model that we're going to see more and more of, more and more interest in, because ultimately what you're getting is you're trusting this sort of expert to allocate your capital across different opportunities that have certain risk profiles and certain risk boundaries. So it starts to emulate a little bit what you have, for example, with like funds, like credit funds, where you have you're sort of you're outsourcing some of like your internal processes and due diligence to someone you trust to do this and that is an expert at it. And they give you a guideline in terms of what type of exposure they're looking to get, and if that fits with your model and what the exposure you're looking to get, you sort of allocate there. So I think that simplifies a lot of things, and it's also an area that's we're seeing a lot of growth in at the moment. Another area which was really quite big, I would say, last cycle, and it is seeing some sort of reemergence, is DeFi insurance. I think insurance, like, so this is, for example, like Nexus Mutual, I would say, is the pioneer here. They had, last cycle, they had a really significant TVL. Now they have still, around a bit over 100 million of like active cover in the system. And what they provide is traditional, like it's similar to a traditional insurance, but for crypto native risk. So things like exploit, smart contract risk, so forth. And we think that this likely, like there's a significant role to play for these types of insurance products, especially as the market itself grows. I think it's an important tool in the toolkit. It complements some of the other tools that we mentioned. For example, the ability to score these risks, and then as a supplement to that, be able to basically ensure if, for example, one instrument has a higher risk score, you can ensure that's part of your exposure. So I think that's another piece that's critically important, and that Nexus Mutual is the pioneer in that area. If we're looking ahead at sort of the future of the sort of on-chain risk space, I think if I would give 3 takeaways from this talk, it is that first of all, we need to make risk management we need to make that a reason to come on chain. We need to make it a strength of the on-chain ecosystem, because if it is not, it's going to be a barrier to adoption. And if it is the area, like if we're stronger on chain versus off chain in terms of risk management, it's going to be an accelerant to on chain adoption and on chain growth. So I think we need to keep working on like better tooling, transparency, risk prices, all these types of things. That leads to the second point, that we need to continue investing in iterating on these types of risk products. I think we need to like have an increased awareness that risk management is critically important. I think for a lot of the on-chain capital that is here today, or that has been here historically, there's a very different requirement in terms of risk management than the type of capital that we need to attract to get to the next stage. And I think we need to start thinking more ahead, that to build out all the tooling, build out the infrastructure for that next phase, so that we can like meet those types of customers where they are today, and provide those, for example, credit traders, bond traders, with the tooling that they expect to be there as they enter the market. And I think lastly, I believe risk management is, as a result, going to be a major like frontier category for DeFi. I think in particular, as it goes into institutional, it's going to be one of the areas where I would expect fairly significant growth, because it's simply going to be a fraction of what this sort of institutional adoption is. Like, call it maybe a third or so of the rest of the market is going to be sort of tied to risk management. And so as these numbers keep growing and as these markets keep scaling, this is going to be a critically important piece to build out. And I'm excited to hopefully see more innovation in this space, more investment, and more interest in risk management. So with that, I'll wrap up. And if you're interested to learn more, please do take a look at us at cork.tech, or follow us on X. Thank you.
Thanks for joining us at STO Summit Spring 2025. Stay curious, stay connected, and remember, the future is tokenized.